Hello, my name's Chris Weston. I'm Head of Research here at Pepperstone, and I'm delighted to be joined by Robert Rennie. Robert is the Head of Market Strategy at Westpac, and it's been an absolute crazy few weeks, I think, in financial markets as rate markets get excited and see a journey, and central banks are now coming to tell us their side of the situation and pushing back to an extent. So it is a real big pleasure to welcome Robert to the program and give his view as one of the predominant strategists here in Australia and Asia Pacific more broadly. And with the bank having so many entwined in the Australian mortgage market, I think it's a really great insight just to understand about what their economics team are seeing about this situation as well, and their call for rates and how it transcends into financial markets. So welcome to the program, Rob. It's great to have you on board, and it has been a crazy couple of weeks in markets, hasn't it?
Yeah, look, absolutely, and I think you're absolutely right here. There's two important positions or movements going on here. One is it's almost as if the bond bears or the bond vigilantes have really woken up here to these slightly less than transitory inflationary pressures, and they basically want to see these yield curve controls. There's these QE policies being wound back very, very quickly, and I think it's obviously very important from a central bank point of view to give off this sort of theme that they're going to watch the data very, very closely. They're going to be very, very attentive. But I think the idea that I tend to sort of see this as a very aggressive terms of trade shock going on. We're seeing supply disruptions. We're seeing high commodity prices. We're seeing measures of inflation rise very, very significantly, and break-evens are definitely reflecting that. But I think central banks definitely want to give off this message that they're going to be patient and they don't want to step back too quickly. And obviously the signals that we're seeing in the long ends of markets with curves flattening and in some situations beginning to show some signs of inversion, I think there's an important message that won't be lost in central banks. So it's really, really interesting watching what's going on at the moment, and it's a great time to be here with you.
Yeah, no, absolutely. And we're going to go into some of those calls in a moment, but we've all been looking forward to the Reserve Bank meeting. We've seen it. I know that Bill and the team changed their call around yield curve control early last week, and I think that call of dropping yield curve control has obviously come to fruition. So with that in mind, obviously going back to the moves we saw, I think it shouldn't really surprise when we saw it. The April 24 line going through 30 basis points. It was slap bang up to 77 in a heartbeat, and everyone was like, right, obviously they're not defending it. It's done. But you called that correctly, and what can central banks learn if you think that we potentially could go through a situation where yield curve control could be used again in earnest? Do you think that the way they exited it should be celebrated? Do you think they did it in a controlled manner? And ultimately, as I say, what do you think central banks around the world will learn from this experience here?
Well, look, I think a message that we will take away is that yield curve control or yield curve targeting, at least as applied to the Australian market, was a big success.
Right.
And one of the ways that you can really see where it has benefited has been in the FX market. I mean, there's a broad set of literature that would basically suggest that the lower interest rates on government bonds that would be driven by yield curve control have contributed to a lower exchange rate than otherwise. Now, obviously, it's very difficult to prove the kind of factual here. You and I have talked about the fair value modeling that I use, and I think you can sort of glean a sense of what sort of impact yield curve control has had on the Australian dollar. I've got a fair value model for the Aussie dollar that's based off the 10-year spread. Now, that would not tend to be influenced by yield curve control, which is obviously focused on the 3-year sector. Yeah. The spread between that model and the yield curve model, which obviously would be impacted by yield curve control, would have averaged about 8% over the last financial year, and that would equate to about a 6% difference on a TWI basis. And that's pretty close to the difference. I remember a speech by Chris Kent back in February of this year, where he suggested that their policies had contributed to the Aussie dollar being as much as 5% lower than otherwise. I think it's probably a bit more than that. Right, okay. I think probably somewhere in the region of 6 to 8%. That's been very, very important. That's had a big influence in the commodity receipts that we've seen coming into the country. And I think it's been a successful policy.
Yeah, okay. I think that's a really interesting situation. I think central bank communication has been such a big policy tool in terms of guidance and the way they communicate that with markets. The Federal Reserve are going through a process where certainly think Jerome Powell has learned a lot as Federal Reserve Chair about communication to markets, and I think, personally speaking, I think he's done a pretty good job. Some people, I mean, a lot of people would disagree with me there, but in terms of Phil Lowe and the board more broadly, how do you think their communication with markets has been throughout this whole process? You talk about yield curve control being a success. I suggest, without meaning to put words in your mouth, but I'm guessing that you see their communication policy has been broadly successful as well.
Yeah, I would definitely agree. And I think even the time that the RBA governor spent with economists, strategists, journalists, etc., yesterday is definitely an important part of that, that communication policy, because I think it's important that the RBA doesn't maybe repeat the mistakes of other central banks. Not that I want to sort of show my age here, but I remember in my early days at Morgan Stanley in the early 90s, when the Bank of England was attempting to defend the sterling peg, base rates in the UK went up to 15%. I just bought my first property in London about 18 months before that, and I learned the very, very hard way, that the costs of defending the undefendable, when you have lost all credibility in the market, there was simply no rate that the Bank of England could have posted that would really have stopped the flow out of sterling. So, I mean, not that I'm comparing the current situation to that point, but the point that I would make here is if you try to defend the undefendable, at the end of the day, it causes very significant shocks from a market point of view. And I think, in your introduction, you mentioned the fact that, the RBA stopped defending the 10 basis point target in the April 24. Off Bloomberg, I think we traded almost as high as 80 basis points. I think coming in after the fact and redefending, you would have lacked credibility. And I think there was a great question that really sort of summed it up for me within yesterday's press conference. I think it was an ABC reporter asked Governor Lowe on whether the RBA had lost the battle with the market and they'd been forced to step back as a result. Governor Lowe sort of shrugged his shoulders and said, look, they simply responded to the faster progress towards their goals. To me, that's a sensible approach. When the facts change, policy has to adapt. It has to change. That's what's happened yesterday. And I think we move on. And I think we've absolutely got the correct communication with the market at the moment. I've been very impressed with the way that the RBA handled yesterday. Great
stuff. Now, I want to take a step back because going into this, we'd seen the Aussie dollar over the last month going into the best performing G10 currency with again about 3.7%. We'd seen, if you look at 3-year yields, not the April 24 listing, but if you just take the generic 3-year treasury, we'd seen it going from around 28, 29 basis points, up to, I think, 122, 1.22%. From the end of September in that period. So that was an incredible move and one that Dr. Lowe coined as completely over the top, or words to that effect.
Overreaction.
Overreaction, that's the one. But, obviously the markets had priced in an incredible scenario, not just over the next 12 months, but 24 and 36 as well. And so, where we are now is after the RBA meeting, we've recouped some of those moves in yield. We've got the 3-year treasury now trading around 90 basis points, so some good buying coming through. But what have you been suggesting to clients, even at 90 basis points, and given what's even now priced in the curve, with just over 3 rate hikes being priced over, what are you suggesting? Is this still too rich? Are we still pricing in too much? Is there a buy going on in the rates market here?
Yeah, look, and I think it's the logical trade from our point of view is that if the RBA is going to exercise a lot of flexibility here, and I think absolutely that was the message that we got yesterday. This is not the RBNZ, this is not the Bank of England, this is a central bank that really believes that the economic welfare of the Australian people is an important policy consideration. I don't know if you remember the Annika Foundation event back in July 19. The RBA Governor Lowe spoke extensively on that. For Lowe, it's all about inflation on average over time, embedded within the broader objective of welfare maximization. I think that's a very different approach. We could talk about the flexible average inflation targeting that we have from the Fed. And there's many other sort of iterations of this policy. But I think the key takeaway from yesterday is that the RBA sees itself as having a lot of flexibility and it will will use that flexibility as it tries to maximize the welfare of the Australian people. If we can give more people more high-paying jobs without pushing the midpoint of the inflation band, that's what welfare maximization is all about. So how do you play that? Look, we went into the RBA meeting with a received Feb 23 OIS call. We basically said that at 1.25%, the market was pricing in way too much. And obviously the RBA governor agreed yesterday when he talked about it being a complete overreaction to the data. That's narrowed into about 110. I must admit, when I talked to my front-end trader yesterday afternoon and I looked at the OIS run, I was actually a little bit surprised that it hadn't narrowed further. I wouldn't be surprised to see that pushing back inside of 1%. And I also tend to see value in the long end as well. Okay. 10-year sector, let's face it, around about 30 basis points. I wouldn't be surprised to see that moving all the way back into sort of the 10 basis points. So, you pick your point on the curve from a risk reward point of view, but I think there's a lot of opportunity there. And again, if the market does overreact to a piece of data that shows higher inflation pressures, etc., I think that gives you another opportunity because, again, I think that message is very, very clear. The RBA governor is going to use that flexibility that he feels he has.
Yeah, I'm interested because we've got wages now. They made wages as the sort of the backbone of this inflation pressure. The next wage data comes out on the 17th of November. We don't actually get Q4 CPI until I think at the 25th of January. So obviously Dr. Lowe and the team want to see consecutive periods of above target inflation on the trim mean number. So we might have to wait till January for the markets to really come alive. But for you, that wage data that we're going to get on the 17th of November, we were at 1.7% year on year in Q2. Have you started any early forecasts on that wage data? And just how important will it be for the Aussie dollar and for the rates market as well?
Look, Chris, you're not the first person to ask me that. I must admit, you were beaten a couple of days ago by a couple of intelligent clients offshore, which basically asked me exactly the same thing. What's your early forecast? So with that in mind, I think what we're going to do is emphasize that it is early days. Let's face it, looking at the Q3, the economy was only just beginning to reopen really through October. So it's really hard to see where wage pressures come from. So at the moment, the early forecast, remembering this is not my forecast, Westpac's forecast, we've got another 0.4, but that's actually enough to lift the year-on-year rate to 2.1%. And of course, as we see Q4 and Q1 data, we have quarterly rates rising to, I think off the top of my head, 0.5 and 0.7. And that will lift, and that story continues really through next year. And we've actually, and this is where our forecasts are different from the RBA's forecast, we've got wage prices at 2.8% by the end of next year. And that's obviously pretty different from what the RBA is forecasting. We're forecasting GDP growth of 7.4% in 2022. The RBA is forecasting 5.5%. We've got unemployment at 3.8% by the end of 2022. And obviously, as we heard yesterday, the RBA is at 4.25% at the end of 2022 and 4% by the end of 2023. So that bigger than the RBA's forecasting rebound in the economy next year, that further drop in the unemployment rate, those are the factors that really give us that wage growth at 2.8%. And that, as Bill Evans, Westpac chief economist, has been emphasizing since June 18, we've got our first rate increase will be the February 2023 board meeting. Yep. And again, that's really because Westpac expects core inflation to print above 2.5% during the second half of 2022. That drop in the unemployment rate, stronger growth, driving stronger wage growth. Yeah. That's what gets us to that February rate hike in 2023. So
that's interesting. So you're February 23. The markets are they're looking for a couple of rate hikes next year.
Correct.
And that divergence is still very much in play. So how do you see this? I mean, we talk about what you're listening to the RBA. They're data dependent. They've moved away from calendar guidance. And I think that's quite an intriguing and probably the right call to do in this current situation. They've moved away from extraordinary measures. They're not needed anymore to the extent that they were during the pandemic. And I think, yeah, this is just the evolution of policy in their mind. We've moved to this data-dependent scenario. But let's say you're wrong and the market is right. What are going to be the triggers? Is it just going to be wages? Is it going to be lower unemployment and that Phillips curve moving together? What are the signs, Bill and you guys are going to be looking out just to say, we're going to move our call forward?
Oh, look, I mean, that's a very, very good question. And it's something that I've not really thought an awful lot about. Let's face it, at the end of the day, we like to think that we're right for the forecasts rather than, why we might be wrong. Look, I mean, obviously, there's a number of risks out there. In the last few days, we're showing signs of accelerating reopening within Australia for fully vaccinated individuals. The flip side of that is that those that are not fully vaccinated will probably not enjoy the same degree of flexibility. We'll be watching very closely for sort of rigidities within the labour market. We'll be watching sort of internal as well as external border reopening. I mean, let's face it, we want to see that migration story returning. Let's face it, we know that there is a shortage of workers in certain industries, things like accounting, finance, and let's face it, agricultural markets as well. We want to see greater flexibility, but were we to be in a situation where structural issues remained, but we get tremendous pent-up demand, that may mean that we start to see some signs of additional shortages developing in certain sectors of the labour market, or even increasing. And that may be something that drives up wage growth in the short term. Key question there will be whether or not the RBA is willing to look through it. And I still tend to think that story of welfare maximisation, inflation on average over time, with that embedded sort of broader objective of welfare maximisation is important. So I think even if I sort of saw the market getting very nervous and very jittery, I would certainly be looking for opportunities to fade that nervousness within the market.
Cool. I want to touch on the Aussie dollar. You talked about a fair value model. Now, this isn't your house call, but a fair value model that you've modelled based on RBA modelling and equations that they've used. Is higher at around 90 cents. Now, if we have a look at the bond market at the moment, the yield premium on offer in Australia is at a premium to, certainly well above in Europe and the UK and the US now for the first time. So as an investor, as a fixed income investor, you can get additional yield, whether that's on a nominal basis and even more so on a real basis here in Australia. So it becomes quite attractive to invest in Australia. The other side of that equation is the falling terms of trade. Now, I know you follow iron ore, coking coal and the bulks very, very closely indeed, but we've had a massive decline since July in Dalian futures, SGX futures in iron ore. Short interest has been building. Are we close to a bottom now and seeing some value in some of these bulks, or do you think there's more to come? And how does that affect your Aussie dollar call?
Yeah, look, a couple of really great questions. And obviously, I guess we have to sort of watch, particularly through the tail end of this year and beginnings of next year. Look, I've actually been quite surprised that iron ore has not been below 100 for some time now. I run a fair value model for iron ore, and that's basically the equation for that. It's basically a supply and demand model, and it basically says the price of iron ore is a function of domestic steel production. I include domestic iron ore production. I include scrap imports, and then I look at Australian and Brazilian exports of iron ore, shove it all into a great big equation, allow for a bunch of lags on it. And it basically says that the iron ore price should at the moment be somewhere between $70 and $90. So your question was, are we close to reaching a base? I think the answer to that question is, well, at 90 something US dollars, we're closer to that point, but I can still see a scenario where we trade lower. What certainly does interest me is that steel prices in China, even in a period where we know steel production caps are being put back in place, Importantly, steel prices are actually falling. That's something that you very rarely see in China. When you cap steel production, for whatever reason, everybody goes out and hoards as much steel as they possibly can. So the price of steel goes absolutely through the roof. That is not happening at the moment. And we would have some finished steel products, so hot rolled steel prices, off the top of my head, would be at the lowest level that we've seen in 5 or 6 months. That tells me that not only is the demand for iron ore falling because steel production is being capped, but the demand for steel itself is also falling as a result of, let's face it, blue skies policies, common prosperity, caps on steel production, et cetera, et cetera. There's a whole bunch of sort of factors here that are driving iron ore prices. So very long-winded answers to your question. Yeah, I think we're closer to finding something of an equilibrium, but I wouldn't be surprised if we still see a drop below $90. So all of that does, definitely I've emphasized the strength in my fair value model, but I think if you take into account the recent very sharp weakening in commodity prices, that starts to take a little bit of the froth off the top of that model. And obviously the movements in interest rate differentials do the same again. And look, certainly in the short term, I went into the RBA yesterday thinking that the Aussie dollar was overdue a correction. I certainly sort of think that we could see a dip back down towards sort of 73, figure 50, that sort of area, which would be the top of the Ichimoku cloud, I think, off the top of my head. I would see that as a good buying opportunity. The point I would make here is I want to buy dips. We're forecasting 75 year end, 78 and next year. And I still am optimistic in commodity prices on a medium term basis. I do think that copper could go a lot higher. I think aluminium could go a lot higher, depending, of course, what happens with infrastructure bills in the US. Build back better schemes in the UK and European infrastructure packages as well. They're all important in that. But on a medium-term basis, I'm definitely more optimistic on commodity prices, and that argues for using weakness in the Aussie dollar as a buy opportunity.
Well, that'll make sense. If we're going to see some of the yield come out of the Australian market, maybe on a relative basis, the commodity prices dip, maybe get that 73 handle, which could be a buying opportunity going forward. And I just want to sort of just take one more really quick question. If we can just wrap it, just keep it brief. If the markets are going to get, you've talked about the idea that we probably won't get rate hikes until early 23. But if we do see a situation where rate hikes are going up at the same time as macro prudential, which one suspects is going to be the first cab off the rank, does the housing market concern you at that point? Given the leverage that's involved, is there a tipping point where it does sort of feed back into household spending and there's a feedback loop? So is there a tipping point with rates, or is there a red flag that we should be looking out for housing that rates play into?
Yeah, look, and I think that's a very good point. I mean, as you know, we're forecasting a 22% gain for property for the full year next. But that that momentum will continue into 2022. So 22% full year this year. We've got 8% gain next year, and obviously, as you emphasised, there macro measures beginning to kick in, and that starts to slow the momentum in housing. And then we've actually got a 5% correction in 2023, and obviously that getting the timing right for the RBA call is obviously critical there. So we've got the rate hike in February of 2023, and obviously money markets will be well on top of that and discounting it. Now, obviously, if rate cycle starts sooner or is more pronounced, that would certainly imply greater risks of a larger correction as we move through 22 and into 2023. And obviously, I mean, part of the question that you asked there is really what's that, what are we thinking really is that sort of neutral RBA rate, upon which if you go beyond that point, that you really start to see the economy being hit much further. And obviously I rely on Bill's forecasts for this, and I off the top of my head, I think the number that he sort of emphasizes would be in the region of sort of 1.25%, which really sort of emphasizes that the household, the consumer, is going into this cycle with a fair degree of leverage on the balance sheet. So that's obviously something that we're going to be watching very closely. And obviously, we have to take into account offshore developments as well.
Yeah, sure.
We're expecting 2 rate hikes or rather, money markets are pricing in 2 rate hikes for the Fed before the end of 2022. Westpac's forecasting that the Fed will begin its tightening cycle in Q4 2022. So we're certainly not as aggressive as the offshore market in terms of our expectations for the Fed. But developments there, I think, are going to be very, very important as well.
Yep. Well, that's fantastic insights there. We've looked at Rob's model, but more importantly, the house call and some of the inputs that maybe see the Australian dollar have a dip down to 73 potentially, and that could be a potentially buying opportunity. Looking at some of the rates markets at the moment, they've become overzealous, they've become a little bit rich, and there's still some trades and potential for some buying across the curve in that situation. Still bullish on property. I think that last point was incredibly important, and that's the neutral rate for the cash rate being around 1.25%. That's the rate that it starts to be restrictive, given the levels of unemployment that you get in the market there. So some fantastic views, given that we've seen the Reserve Bank coming out, given them, mark to marking everything that they're seeing at the moment, and getting one of the biggest banks in Australia's views and the strategy team there. So really trying to bring it back together and give us some insights for going forward into what will be the new year. Obviously, a lot of those offshore situations going to dictate the situation as well. So Rob, thanks very much for your time. Some great insights and a great interview, and I'm sure everyone benefited from that. Thanks for your time.
Great to be here. Thank you.
Cheers.